Hey everybody, Brian Gleis here, and you're in luck today because the Scott Agency Employees Benefits team, not all of us, but the most important, no, I don't want to get fired, so it's not the most important ones. But guys, we're here to talk a little bit about employee benefits. We have a lot of employers that it's very, very top on their list. I've got Mark Blassie here, who's our employee benefits head as far as division goes over the entire state. I've got Matt Spate here, who's the CEO of our organization, and then myself, Brian Gleis. I work for him out of the Warrenton office. And you hear a lot of buzzwords out there, whether it is a traditional health insurance plan or a self-funded plan. I want to debunk a little bit of the mystery behind those. So what I'm going to ask Mark to talk about, and then we'll chime in, is different ways that you can physically fund or pay for your health insurance benefit plan, because there's a lot of them out there. Mark, let's kind of wade into this topic and kind of, at a high level, demystify some of this stuff.
Brian, as you would expect in an environment like we're in over the past 5-10 years where healthcare costs continue to rise, in response to that, consultants and carriers themselves like Blue Cross, Anthem, United, Cigna, collectively, we've looked at ways to alternatively fund health insurance. The most traditional and common way of funding your health insurance is to pay a premium to the insurance company in return for them to pay your claims. Call it guaranteed cost basis.
And Mark, I'm going to interrupt you, because on that guaranteed cost basis, the way we have identified it before is it's basically the insurance company doing the math and saying, this employer is going to cost me this much money over the course of the year. Let's divide that by 12, and that's the premium that they pay. All right. So when we talk about a fully funded plan, the traditional plan that you guys are used to, essentially the health insurance company is doing the math, looking at the ages of the people, doing the underwriting, or their bean counters are hired to do this. They figure out how much that program is going to cost. They divide it by 12, and that's how much you're going to pay.
What has evolved is the next step away from that fully insured program is to understand the health risk of your members and dependents that are on the plan. And if you have access to that type of information, you can better understand your risk so that you can determine, should I take a little more risk? Meaning, should I perhaps invest in a level funded program where, as an employer, I have an opportunity to recoup some of that premium dollar should my claims fund be in a positive position. And that's an opportunity for the insurance carrier to give back some of the margin that they make on the fully insured program. And Brian and Matt, that design is becoming more and more popular, particularly for groups that understand that their demographics are leaning towards being more healthy than not, because you're rewarded for good behaviors. It's also an opportunity for employer sponsors to get their employees to commit to better health management. With better health management, lower claims. Lower claims mean there's an opportunity to share in that surplus, that differential between premium and claims.
And that can be a game changer. So guys, what we're talking about is moving from a fully funded traditional plan to a plan that you have more control over. Now that can be a huge mind shift from that, and we have to help our clients with that. I'll go ahead and give you some real world examples. We moved one of our clients from a traditionally fully insured plan to a partially self-funded plan, and it took them a good little while to embrace that they were the actual insurance company. And what do I mean by that? Me and Mark were able to look at the numbers, and that we saw that there was a large percentage of their emergency room visits for non-emergency things. So me and Mark immediately went into education mode, and we started to educate the employees on the lowest cost of care. We told them that urgent cares, primary care physicians, teledocs should all be in order before your emergency room visit. But because the employer is now the insurance company, we also increased the amount of copay that it costs to go to the emergency room. The copay to go to the emergency room was extremely low. We increased it not to an outrageous threshold, but we increased it to enough to make the consumer, the employee, think, do I really want to go to the emergency room and pay that $250 copay for a sore throat if Teledocs is free, okay, or urgent care is $25? And the actual employer was the one that had control over that. By driving those costs down through creating best practices with the employees, as Mark just said, the employer was able to retain some of that money because they drove their claims down. They were able to retain that money instead of give it to the insurance company that happens in traditional funding.
Brian, the examples you're using can be captured in the word more control.
Yes.
So as you move from the traditional fully insured program, you pick up opportunities to look at optional ways to reduce your spend, whether it's through pharmacy, whether it's through wellness, whether it's through virtual care. As you move away from that total control of the insurance company to an environment where you have options, it gives you a chance to determine whether some of those options are good for you.
No, absolutely. So the self-funded platform or the non-traditional platform is not for every single employer. You have to have the numbers, okay? And there's some movement out there that are trying to take smaller employers, your 5s, your 10s, and your 20s, move them from their fully insured platform, which number one, we have to, if you're on a fully insured platform, we have to make sure that thing is working as efficiently as possible for you and you're using all of the tools that are inside of that program. We find that is an error that a lot of folks don't do. They don't wring the benefits and the options out of their current program. But if someone is encouraging you to drop your traditional program because of pharmaceutical costs or because we have this great new deal, you have the opportunity to join a membership organization or a consortium or a larger group of people. Sometimes that's appropriate, sometimes it's not. You have to make sure that you trust the individuals that are sitting across from the table. And if you have someone that's coming in, and the term that we've used is evangelizing, all right, because we've sat through a presentation where this person just pounded on us for 5 minutes and you really didn't get a word in edgewise. Call your current broker, talk to them about it. If you're interested in a fully insured plan, a partially self-funded plan, or if you're just simply interested in kicking the tires on the choices that you have, the Scott Agency is here to help. Mark Blassie does all of Missouri. Mark's the architect. He brings the pieces of the puzzle together, and then we decide how they fit together with the employer's needs. Me and Matt are boots on the ground. Matt's in Montgomery City. I'm in Warren County. Yes, we can do the entire state of Missouri, but we hit our local people, and it's a family-run business. So Matt's grandpa was handing out Matt's business cards back in the day. When I got hired on, Mr. Duran was still alive, and he sat me down, and he looked up at me, and he said, "Sit down, son. I need to tell you how we do business at the Scott Agency." That's a memory that will stay with me forever as far as that goes. And it's just exciting to be part of a grassroots organization that still values the employer and the employee. So, Matt, we've been in business since 1935, and still a family-owned organization. Before we leave you, we're here at the beautiful Oliver's Restaurant in Warrenton, Missouri. It's starting to get busy here. We've got a 20 top downstairs that is going to be very, very happy here in a little while. If you have the opportunity, you're in Warrenton, Missouri. Even if you're not in Warrenton, Missouri, I would encourage you to make Oliver's Restaurant a destination. Great place to eat, good people. I hear they have a great insurance agent, wink, wink. But it's all good. Thank you for your time. We appreciate you guys. Bye-bye.
Thank you.